Hey everyone, it's Kirk here again at Option Alpha. So in this video, we're going to talk all things position sizing, seeing if we can increase our profits by properly sizing our positions. So really, we've heard this one before, which is the too big to fail. But in this case, I scratched that out and I said, could you be too big to succeed? And I'm talking about your position sizing, of course, because one of the biggest risks for traders is the unknown sequence of returns, even for high probability trades. This seems to be the continuous killer for traders. It seems to be something that not a lot of people talk about, don't think about it. Hopefully I can help explain it in a better way today so you can get you over this hurdle and into proper position sizing. But we'll also go through some back tests that kind of show and kind of prove this point as we go. So again, position sizing too large exponentially increases your chances of blowing up your account. We're already trading a leverage product, which is options, so we don't need to position size big, but typically people do, or they just don't even pay attention to it. They don't know how to calculate it, so it ends up being a problem. So this is a sequence of returns table that I've used a number of times in training, and so here's how it works. So you basically have consecutive losses on the top side here, so you would say one consecutive loss, so basically any loss that you would have, 2 consecutive losses, 5, 10, 20 consecutive losses in a row. And then down the left-hand side, you have your probability of success for the trade that you're targeting. So for example, we'll just use to start out, like let's say a 50% probability of success. So this would essentially be a coin flip. You just flip a coin. There's a 50% chance it's heads, 50% chance of that it's tails. So this would be a 50% probability of success. And what this shows is that if you have a 50% probability of success, the odds of seeing one consecutive loss in a row is basically 1 in 2. Now this makes sense because 1 out of every 2 flips statistically is going to be a loser, right? So this is why if you were to trade, flip a coin, you could see heads or tails 1 out of every 2 times. Makes total sense, right? And so if we use this and kind of think about this in the realm of position sizing, then we can start to build this framework around why position sizing is so important. So let's play a game real quick where we have a bunch of coins that we're going to flip. So we're just going to play this coin flipping game. So we're going to be betting on coin flips, and we're going to do 100% of our account on every flip of the coin. Now I know this seems crazy, and it is, but it's trying to prove a point. I'm not saying that you obviously do this. It would be really stupid to do this. But let's say that you were to bet that it lands on heads, right? So that's what you hope, and you bet the whole farm, everything, right? 100% of your account on one flip of the coin. So now the coin flips and it's a loser, so immediately you're dead. This is it. I mean, this is the one chance that you had, right? And you just bet everything on a 50-50 shot, 100% of your account position size. And it ended up being that the coin flipped and now it was red, it was tails, whatever, it was a loser. And so you're out, you're done, you're wiped out. And so this is what this chart is saying, is this chart is saying, look, one consecutive loss with 100% position size, right? If you have 100% position size, one consecutive loss, basically you've got a 1 in 2 shot of blowing yourselves up, even with a 50-50 bet, right? Or 50-50 probability of success. So let's take it just like one step further, okay? So let's do now, we're gonna keep flipping this coin. So the first one was a loser, but let's assume now in this scenario that we did 50% of our account per position, right? So we kind of cut this down in half. We said, all right, we're not going to do the whole thing. We're going to do 50% of our account per position. Now, if we go back to this table, 2 consecutive losses, 2 sequence of bad trades is going to wipe us out, right? Because we have 50% of our account. So if we lose 50% on the first trade and then we lose another 50% on the second trade, that's 100% when I do the math, and that basically means you wipe out your account. So what we're looking for here is basically the idea that 2 consecutive trades are going to wipe ourselves out. Now, if we get 2 consecutive trades when we're targeting a 50% probability of success, the odds of us blowing ourselves up is basically 1 out of every 4 times. And that's still pretty great odds. I mean, that's 25% of the time we're going to blow ourselves up. So let's keep playing this game, right? So we've got 50% of our account per position. First flip of the coin goes, it's bad. Next flip, it's good. Maybe it's heads, whatever, it doesn't really matter, but it's a winning trade, right? So now we have this winning trade. So now we're kind of back to square one. Then we have another, set of trades where we have a loser winner. And then we get to this point here where we actually have 2 consecutive losses in a row. And so you can see that what we did just by cutting our position size in half, we basically are starting to extend the duration of our trading strategy. The ability to stay alive extends longer. Our half-life, if you will, like extends out. And so now we have this ability to trade longer, but it didn't really do much. I mean, we didn't get too far out. We kind of extended the deadline, if you will, the expiration period for our strategy out a little bit. But once we got 2 consecutive losing trades, then we were out, okay? And so this is what happens all the time, is that people just over allocate. They put too much capital into it, where only a few consecutive losing trades in a row, which have very low chances of, like, very good odds, low probability of staying alive, high probability of blowing yourself up, right? This is what happens. Even with 80% winners, 70% winners, 60% winner trades, which you can build as a trader. You can build trades that have a 60, 70, 80% chance of success. But if you position size too high, then 2 consecutive losses in a row just blow yourself up. So at this point now, you're probably thinking to yourself, and I don't want to take this too far, but this is really what people start to do. They start to act a little crazy, a little squirrely. They start thinking this whole game is rigged, right? I was trading 80% chance of success and I still blew myself up, so therefore it doesn't work. But it mainly comes down to position sizing all the time. So let's play a different game this time. So let's play a new game where we're going to actually go down in position sizing to 20%. Now we're going to just continue to move out this spectrum here, if you will, and we're going to go down in position sizing again to 20%. So we're going to be thinking, okay, look, 20% allocation. If I were to lose 20% 5 times in a row, 2020, 2020, then essentially that equals 100% loss on my account. So if I'm targeting now 20% allocation, which again, I've seen people do this all the freaking time. They over allocate position sizes, especially on small accounts, because you're just not calculating it out. And so now 5 consecutive losses in a row is going to blow you up. So it's not that it can't happen, because it can happen. It just probably extends the timeline in which it does happen. So if you're still flipping a coin and you've got 50-50 chance of success, that means that our odds of blowing ourselves up now, because now we need 5 consecutive losses in a row. 1's easy, 2's a little harder, 5 becomes a little bit harder, right? So at 20% allocation, we need 5 consecutive losses in a row. That's a 1 in 32 odds of blowing ourselves up. So if we did this, we start betting on these coin flips, right? And now let's assume that we're doing 20% per position size, just kind of extending out the number of bets that we had randomly. You can see I've got a group of 2 here, and then I've got a group of 2 here. So if you were trading 50% allocations, these would be dead zones. You would have blown yourself up. But because our position sizing is smaller at 20%, we can survive and live through these zones, right? And so now we get to this point where we're extending out the number of trades we can do. We're extending our lifeline as a trader, and we get to this point where we have, potentially some, fairly good odds, right? But then what happens is we start to get another set of losing trades, this time maybe 2 losing trades in a row. We start thinking to ourselves, okay, I don't know, I've seen this before, let's keep going, right? And then we get 3 and 4 losing trades. So now this is something we haven't seen before. We haven't seen 4 losing trades in a row. We're still okay. We both basically blew up most of our account, but we still got some capital left to allocate, right? And then at this point, you get to the 5th losing trade and you die. This is what happens, right? So even in a coin flip scenario, this can happen. This can happen where you just flip and you get a random sequence of 10 tails in a row, right? You were betting on heads, but you got 5 tails in a row. And this is the killer of traders. It's literally what happens. And the problem is most of the time is that what would inevitably happen is when you start a new strategy, you start right at the beginning of probably a bad sequence of returns. Not that anything is rigged or bad or whatever, just how the, kind of trades fall, right? And so in this scenario, now you blow yourself up. So that's what happens here, where you get to this position where 5 losing trades in a row knocks you out, right? And that's really important, not only just to understand, the likelihood of that happening, but also the odds around different position sizes and different probabilities of blowing yourself up. So let's now take it to the furthest degree here. Let's go all the way up here and try to target something that can withstand potentially 20 consecutive losses in a row. Now, 20 consecutive losses, if you truly get 20 consecutive losses in a row, you would blow up your entire account. That's if you allocated everything, you're on the wrong side of the market for all the trades. But let's just assume for the sake of argument that we're going to try and build something that can withstand 20% or 20 consecutive losses. even at a 50-50 shot. So basically a coin flip. Now, if we were to do this, ideally we'd be targeting something under 5% per trade. And this is just how the math works out, because at 5%, if we were to lose 5% 20 times in a row, when I do the math, that's 100% of our account. We blow ourselves up. And at 50-50 shot, a coin flip shot, the odds of seeing 20 consecutive losses in a row is 1 in 10.4 million. So that means that our chances of blowing ourselves up are super, super low. We can basically withstand lots and lots of pressure on our strategy, which might just randomly come. So now we go down to our coin flip example here, kind of our table, and you could see this is our example from before. This is where we stopped before, right? This is what blew up the last strategy, is these 5 trades. But we don't know if those 5 trades are just in and of themselves a bad sequence or the start of an even longer sequence of bad trades. And you can see that right here, I just kind of modeled out the idea that what if you had 9 losing trades in a row? So at 20%, you didn't survive those 5 losing trades in a row, right? Probably didn't survive it at 15%. And if you get out here where you do have just a bad series of trades, a streak that goes against you, you got to be able to withstand it. And at 5% per trade, we can withstand that because we can withstand up to a 20 consecutive losing trade in a row streak or sequence of returns. And so this is why this is so important, because you got to be able to trade through these scenarios where they don't actually blow yourself up. So what's cool about this is you can actually kind of model this out. We've done this a number of times. Here's some of the charts on this. If you actually modeled out coin flips that are targeting 50-50 shots, this is why it's so important, because it's not that you just have the right position sizing. It's true, but you got to be alive long enough for these probabilities to stick, right? Because it's not that a coin flip is always going to be heads, tails, heads, tails, heads, tails. It's going to go through these periods where you just have lots of heads and then lots of tails. And over time is when it actually starts to normalize to more of a 50-50 heads and tails. So if you actually simulated this, and we did this and published this a while ago, but we did 10 random flips of coins, right? You have lots and lots of variation between heads and tails in the first 100 trades, right? And this is where sequence of returns is going to kill you as a trader if you're over position sized for everything, is because you could just get into a scenario where 70% of the trades at the time that you're trading are going to be heads, right? And that means that if you're betting against heads, you're going to lose. It's not that the coin is rigged or the coin is, unbalanced or weighted. And this is what people do in trading. They get into a strategy and they say, okay, I'm going to be an 80% winner on this strategy, or this iron condor strategy I'm running should win 65% of the time. And then they go and they start trading in the first 20 or 30 trades, they're only winning 10%, right? And they think, well, this is all, made up. This is all make-believe. But it's just that you haven't had enough occurrences to get to the statistical outcome that it should be, right? And so now what you see, even with these 10 coins, is that the longer we flip these coins, the more we flip these coins, the more that the stats start to converge around their target, in this case, 50% heads and tails. If we take this out even further and we do 5,000 coin flips of these 10 different scenarios, you can see really in the first 500 flips of the coin, it was still like 45, 65. It really wasn't really hard and tight around 50% until we got much, much further out the spectrum. And so this is why it's important, because you got to be able to survive. You have to survive this time period as a trader. And the way you survive that time period with these random sequence of returns that you could have is through position sizing. So the next question becomes, is this all applicable to trading? All we've talked about so far is coin flips. Yes, of course it's applicable to trading, because in options trading, you can set up these probabilistic payoff scenarios with known profits and losses. So you can know how much you're going to win, how much you're going to lose, and the probability of that happening. And then you can take that and start to position size that appropriately. And you can even backtest those, which I'll show you here in a minute, into different strategies where you can test the different position sizes. And so, for example, if we were going to target, and I think in this example coming up, we targeted something around 70% chance of success. So just a series of trades, credit spreads, iron condors, etc., highly liquid tickers. And we did it around 70% chance of success. Here's what the distribution of those win rates were over the first 100 trades. You can see over the first 100 trades, even though we're targeting 70% winners, which is in this zone, you get a lot of variety in here for these different strategies that we just tested randomly, right? And then you start to go to 250 trades, you can start to see it's starting to kind of come together. It's starting to, converge on the expected outcome, which is 70% winners. You get to 500 trades, everything is inside that, kind of zone around 70%, but you got to be able to survive this. That's what you got to be able to do. You got to be able to survive those periods where you have big losses, maybe infrequently in your strategy. And again, you go over to 1,000 trades and then to 2,000 trades, and you can see that it becomes very, very tight around the expected outcome. So your job as a trader is just to survive long enough to see the expected outcomes work out, which means that when you position size, I truly believe you've got to be in the 5% or under category. The smaller you can be, the better. I know it's tough for smaller accounts. You're probably going to be pushing up against this 5% threshold, but you really don't want to go over that. For larger accounts, you certainly want to be in the 1% to 2% range for sure. And that's going to be for the position symbols that you get into. So let's look at some examples here, because I think this will help out first too. So this is a back-tested example. And again, you can do this right inside of Option Alpha. I'll add links below this video so you can check out all of these. You can run your own tests and do some variations and copies in there. But in this case, what I did is I just tested some different strategies with just different position sizing. That's it. And what's cool about this, I think, is that you can see the effect of position sizing visually, because it is very powerful to see this visually in addition to going through the stats. So the first test that we ran here was just an afternoon iron condor position. The legs, it doesn't really matter, but it was basically targeting about 50 to 60% probability of profit trades. So that's what you'd be targeting, is a little bit better than a coin flip, okay? And you can see the baseline scenario here is just one contract. So these are all exactly the same. This is the baseline scenario, which is strategy A. That's in the blue here that you can see. And that is one contract at a time. So that, I say it's a baseline because it kind of gets the stats around the strategy. It doesn't have any impact on position sizing. And this is where you can see strategy A's win rate was 58.2%. It was a winning strategy, which was good. It made $13,000, good profit factors. Won't go through all these numbers, but you can see here that this was a good strategy to go through. Down here below, this is why I want you to focus on sometimes with your backtesting, or at least just check it. You got to check it, is your win streak and your loss streak. We put these in here specifically because of the sequence of return that we talked about in the beginning of this video, where you want to know, and I want to know, okay, if I run this strategy, how many wins am I going to have in a row? How many losses might I, mentally prepare for that I might see? And you can see here that you had 7 losses in a row. So the good thing is that we were doing one contract at a time, so that didn't really make an impact. But later you can see that that does have an impact on the strategy overall. But 7 losses in a row, and then wins, we had 9 wins in a row. So again, just like you could have a sequence of bad returns, you could have a sequence of good trades where you feel like a rock star and you're like, I've found, the holy grail of trading is just a random sequence of wins, right? All right, so next thing I did is I tested 3% of capital. So I said, okay, look, if we bump this up and we start, allocating capital a little bit differently, now I'm going to test 3% of my capital for each position size, which favorably would adjust position sizes down if the strategy starts to lose, but then start to increase position sizes if the portfolio as a whole starts to go up. And so you can see we got marginal improvements by increasing our position size up to 3%. It didn't always beat. It wasn't always the same. You can see right in here, if you kind of squint your eyes, that the orange line is actually underneath of the blue line, which was the base scenario. But at the end of the day, it seemed like it did a little bit better. So we had total profit that was a little bit higher. Our win rate was about the same. Consecutive wins and losses about the same. Okay, so now we're starting to get somewhere. So now we go up to 5%. And I'm not saying that it's always 5% or 3%. I'm just showing you the differences here. But now we get to 5%. And you can definitely see a lot more volatility in this strategy visually. This makes sense because now we're starting to increase our position size. So you got to be able to withstand a lot of that volatility if you want to. That's why I said if you got a larger account, you're definitely going to be in the 1 to 2 range. Smaller accounts, you might have to just push the envelope up to 5% anyway to get into positions. But you can see 5% of capital, a lot more volatility here. And overall, if we just, kind of visually just forget about strategies D and E for a second, you can see you would assume you're moving in the right direction P&L wise, right? Your profits are your win rate is staying about the same, right? So now you feel good. You're moving in that direction. the thing that you're going to have to be concerned about is things like this, where you have these big drawdowns, right? So your worst loss here was 2,700. Your biggest drawdown was 18,000. So now you've got to start to ask yourself, like, can I mentally go through that? Can I withstand that type of, market environment? So now what I did with D is I started to really jack it up. I said, okay, look, 25% of capital for every position. Now, in the early days, and this is why I love this chart so much, in the early days, you looked like a genius. This is the fallacy that happens all the time. This is a false flag. It's a false positive. You get into these positions where you look like an absolute genius, and then you absolutely start allocating more capital and higher capital amounts to your positions, and then you blow yourself up, because that's exactly what happened. Is you had this huge run up, you did really well, and then you completely collapsed, and you just went through these spits and fats of just like massive run ups and massive drawdowns, just so much volatility in your account. But at the end of the day, you still lost pretty much all of your money. You can see your win rate or your total profit was much lower. Your biggest drawdown was much higher. Your worst loss was much higher. And really, you didn't have that many. The losing streak was a little bit less because you actually got into a few less trades at the end of the day. You just couldn't actually get into the number of trades that you needed to. So this is where you can start to visually see that just too much money allocated, even to a winning strategy in its baseline scenario, breaks the whole thing. Like, the only thing that I changed here, I didn't change anything else. The only thing that I changed was the amount of money that we allocated to it. And wrongly, people assume winning strategy, allocate as much money as possible. That's totally the wrong methodology. If we take it to the furthest degree, you can see the strategy E down here. This one is 50% of capital per position. So this was uber aggressive. You got very lucky early on where you had some wins, and then you quickly lost all of your money. This is a really stupid way of doing it, but a lot of people do this. They find a good strategy, or what they think is a good strategy that they've back tested, even with a small, allocation like 1 or 3%, and they think, okay, we're going to go big, and it didn't end up working out. You only got into 54 trades because ultimately the 4 trades that you had here basically blew up your account. So you had a streak of trades. There was only just a few that ended up blowing up your account at 50%. It's just really bad, and you lost pretty much all of your money on this strategy, okay? So that was one looking at basically a little bit over 50% chance of success. This one's a little bit different. So this one I did as a wide iron condor in SPX. Again, it doesn't matter necessarily about the actual strategy, just that this one was targeting something with a much higher win rate. So now what you get into this idea, because there's this other school of thought around this, which is that if I have a really high win rate, I can afford to allocate more capital to it. And that could be true or could not be true. Many cases is not true, okay? And so I want to go through these one by one, because it's very important not to just look at the end result and the total P&L, but also the curvature of the payoff diagram, which is why we put this on here and we show you guys this curvature. All right, first of all, we're going to start with the baseline scenario, which is strategy A. That one's down here because strategy D and E is so volatile. You don't really see A, but A was a good strategy. I mean, you made $45,000 with strategy number A, and you had an 82% win rate. If you look down here with this one, you can see your win streak was really high. That makes total sense. If you're targeting a high probability setup, you're going to have consistently higher winners. That's just how the math works out. And then you're going to have the few losers, and those are the ones that you got to make sure you protect against, because those few losers are going to be very big, right? So you're winning on average $200, but if you lose, $600, $700 on average, then a few losers can start to wipe you out. This is that whole penny in front of the steamroller mentality, that you got to position size yourself accordingly so you get over this, right? And so here you had 3 consecutive losses in a row. Still wasn't bad for consecutive losses, but you could have gone through some pretty serious streaks and drawdowns. Your worst loss was $3,600 at one point. Your biggest drawdown was $6,000. Yeah, at the end of the day, these aren't terrible numbers by any stretch for this strategy that you're running here as the baseline scenario. So now we start to allocate a little bit more, 5% of capital. 5% of capital in this case with this strategy didn't do as well, because what you basically saw is you saw that the times that you got into this position with 5% capital, were starting to risk more per trade than you have in your potential profit. So you had this scenario where this was a little bit wider here, a little bit bigger disparity. You were making a couple dollars for your wins, but then you were starting to lose some more because you had these bigger position sizes. So 5% still worked in this scenario, but you can see you got cut down in your win streak and your loss streak because you started to lose money, and it basically started to flatline. So you started to run out of capital to allocate at 5%. So it was probably too big for this. It still made money, but it was probably too big for this strategy. You needed to be much smaller, maybe 2 or 3% of your capital for this strategy, which would be an interesting one to run, by the way. All right, number C, we started to do the other ones similar to the other ones, which was 25% of capital. Now this one's interesting, where 25% of capital definitely made a lot more money, but I think what's important about looking at this is looking at the curvature of the actual payoff diagram that you start to see, which only gets magnified with more capital, and start really asking yourself if you can trade through these scenarios. Now, the key with C and D and E and all of these high allocation ones is that you had to win early. And in this case, you got very lucky over here. You didn't see it, but your early trades were all pretty much winners or had a very high win rate. You got very lucky that you didn't have a bad sequence of returns early, and that allowed you to start to build up capital a little bit faster and kind of build that cushion. But what you did see is you did see a lot of volatility start to develop, and that volatility just gets amplified over time. Now with strategy number C here, you can see that your maximum risk or your maximum drawdown was 35,000 for some accounts. That may be very meaningful. For other accounts, it may be a drop in the bucket. That's about 35% for this one. So it was a pretty big drawdown. You'd have to mentally ask yourself, if you're trading for an entire year and you get to a 35% drawdown, are you really going to keep trading that strategy? Your worst single loss at any one point was $28,000. Now again, on the chart here, it seems like a no-brainer. But when you really go through these stats and you start asking yourself, can I mentally handle my bot going through a strategy where on one day I lose $28,000? Probably not. I would dare to say many people could and then continue going. And you could have done that many times. You had a loss streak of 3 in a row, which means it could have been 28, then 10, then you won 6, then you lost 15. I mean, it could be like that where you have just a bad string. And so that, for that reason, I think this is just a really, really tough one. You're basically risking on average, $2,400 to make $600. So you could really quickly go through some big drawdowns. Now, the same thing is basically true of D and E in this setup. D is 50% of capital. E is 75% of capital, which personally, I'm going to tell you honestly, when I ran this, I was shocked that it even survived. E even survived down here because you just had a couple quick wins early, and it was very much, kind of hit or miss where you didn't have a bad sequence of returns, but you did get into some massive drawdowns along the way. It was very choppy, lots and lots of volatility, by no means an easy strategy to run. You can actually just visually see this, kind of in a way here with the profit factor starting to decrease as you go down here. But these ones were huge. So worst loss in D was 108,000. E, you lost on a single day, 260,000 on your worst trade. I mean, losing $250,000, I couldn't even fathom that, and then still continuing to trade forward. So these are just unsustainable. So the numbers look good. This is sometimes, I think, the problem with people posting backtesting or going through backtesting and just taking the top winning strategy by P&L. It's like they don't look through this and kind of really dig into the details here. All right, so here's another one that's really interesting. So this one was targeting really low win rates. So I want to do all of these different examples, like a high win rate strategy, a mid-range win rate strategy, and this one's a low win rate strategy. So this one by default, just like the baseline scenario is, 25%-ish win rate. So that's what you're targeting, 25 to 30% win rate. If you can see strategy number A here, this is just entering an iron butterfly midday, taking a little bit of profits. This one is this line here. Very smooth P&L compared to the other ones, just because the other ones are magnified, but still was a winning strategy. So if we just kind of dissect strategy A here, you made $6,600. Your maximum drawdown was $2,600. Profit factor was positive. This was not a high probability trade setup. So you did have these periods where you won 6 times in a row and you had some good wins, but your losses were very much high consecutive loss trades, which means that you got yourself into a strategy where you knew at the beginning you might have a run of losing trades. In this case, because it was a low win rate strategy, it was a very long losing streak that you could have gone into, in this case, 22 losing trades in a row. Again, just mentally prepare for this. This strategy won overall. Good strategy, profitable strategy that you could trade, did go through 22 losing trades in a row, which means your position sizing is so important to this one, right? Because what you're doing here is you're risking, $60, $50 at a time to maybe make $100, $200 on a trade, right? So now position sizing is just going to be so much more important. So if we run this same strategy now with 2% of capital in strategy number B, you can see that was the best performing one. It didn't actually do well until the very end. So notably, it actually underperformed for a long period of time. It did allocate itself down, right? It got less positions, less position sizing as it lost early out of the gate, right? With a higher capital allocation than just one. But then it did recover, and you can see it ultimately ended up being a profitable strategy. We gave up a little bit on our profit factor. Our win rate, or our max drawdown, was 14,000. Win rate was still about the same, still went through the same consecutive losses, but we were able to withstand it. That's the point here, is we were able to withstand that. Strategy number C was 5% of capital. You can see it was still a winner at the end of the day. It was less profitable than the other ones, about the same volatility profile as the 2% of capital. Spent a lot more time underwater compared to the actual baseline. So you can see it kind of crossed above the baseline here versus strategy B crossed above the baseline almost a year earlier and kind of outperformed that. So this is where I just tell people, A, you got to test this, but B, the higher you go on these, you're going to go through these longer periods where you're going to underperform just purely based on how much you allocate to a strategy. And so you can see strategy C here was still a winner, but overall was probably a dud. Lots of volatility. Max drawdown was pretty high. Your win rate, you did start to sacrifice a little bit. You got into significantly less trades as well because you just couldn't keep up with it. At periods, the capital was just too great. You had to skip some trades and filter out those trades, mainly down here where you're trying to scrape by and survive for the strategy. But it did end up turning it around. So you kind of, still won out the day a little bit. Strategy number D was 25% of capital per position. You can see with a low win rate strategy, allocating high amounts of capital is absolutely a nail in the coffin. I mean, you might as well flush money down the toilet, which is basically what you did with both of these strategies. Strategy number E was 50% of capital per position. You can see strategy D actually had a low win rate, very much higher trade count compared to this one, almost double. But overall, it just was an absolute dud of a strategy. It just lost all of its money. So never really recovered from the initial burst that it had for a few trades that it kind of tried to probably outperform the other ones if we were able to zoom in on that a little bit more. But you can see that it was just an absolute dud of a strategy. You were losing money left and right. Again, this is a baseline good strategy. Terrible position sizing that ended up crushing the strategy overall. 18 losing trades in a row. Just it can't withstand stuff like that. So in this case, you look at strategy number E. Strategy number E was 50%. It only took a little bit of trades to blow this one up. So 26 trades. Completely wiped out this strategy. You took a good strategy, profitable strategy in its baseline scenario. You over allocated to it. You wiped yourself out. I mean, honestly, tale as old as time for this stuff. So I hope that going through all these examples is really helpful for you and kind of looking through how this all works out for position sizing. Like I said, I think position sizing is truly one of the most important things that you can do as a trader. If you spend a little bit of time appropriately position sizing, you can kind of get yourself through a lot of scenarios that are going to be unexpected because frankly, we don't know what's going to happen in the market. We can't predict when we're going to go through a bad string of trades or good string of trades. So all we can do is properly position size. So make sure you test all of these, of course, if you need to inside the backtester. Like I said, we'll have links to all these backtests that we ran through so you can look at them yourself right below this video. But if you have any other questions, let us know. Hopefully you enjoyed this one. If you did, give us a thumbs up, a like, a share, send this to a trader or somebody else that you know. Help us spread the word about what we're trying to do here at Option Alpha. And until next time, happy trading.